Hi, and welcome to this edition of the Options Learning Center. My name is Rick Orford, and I've been a stock and options trader since 1999. And today, I'm excited to discuss the long call calendar spread and how to use bar chart to get the most out of the strategy. A long call calendar spread is an option strategy that involves selling a call option that expires near term while simultaneously buying another call option with a longer expiration date on the same underlying asset and the same strike price. The trade results in a net debit to initiate the trade. The goal of a long call calendar is to profit from the difference in volatility of both options while relying on theta decay to render the short call worthless. Theta is an options Greek that tells us how much the options premium will lose each given day, all things being equal. The strategy aims to profit from low volatility on the short option and increasing volatility on the long option. By collecting a premium on the short call with the shorter expiration, it offsets the cost of the long call with the longer expiration. As a result, long call calendar spreads are much more capital efficient than buying a longer dated call option alone. Traders often use long call calendars when near term historical volatility, or HV, is low, with the expectation that implied volatility, or IV, will increase as the trade approaches the short call's expiration date. The logic is that the long call's premium increases with increased volatility. Long call calendar spreads can be at the money or out of the money depending on your trading preference and risk tolerance. Out of the money calendar spreads are less risky, having lower starting costs, but they offer a lower profit potential. On the other hand, at the money long call calendar spreads are more expensive and have a higher potential profit, but they're more sensitive to Vega. Vega tells us how much the options premium might change with a 1% change in volatility. So this is an essential options Greek to know when trading calendar spreads. The maximum profit of a long call calendar spread happens when the underlying asset's price trades at exactly the strike at the short call's expiration. If that happens, the short call expires worthless, while the long call becomes more valuable. The net debit paid at the start of the trade is the strategy's maximum loss. This happens if the underlying asset trades significantly below or above the strike price at expiration. The specific price of the maximum loss condition depends on the option premiums at the short call's expiration. The trade reaches the theoretical maximum loss when the short call's premium is exactly equal to the long call's premium, which renders the entire spread worthless. The break-even prices of a long call calendar spread can be found on the upside as well as the downside and will vary depending on the value of the spread, which changes as time goes on. Break-even prices are also affected by implied volatility, making it a challenge to predict since most of the trade's value is derived from extrinsic and therefore variable value. Long call calendar spreads are more complex than trading single leg options, and looking for a specific trade with specific profit conditions will be difficult and time consuming. Thankfully, with bar chart, we've got you covered. Our screener can find trade legs that meet your specifications. Let me show you how. First, head on over to barchart.com if you aren't already there. Then, look to the top navigation pane, click on Options, then Long Call Calendar Spread. Once you click on that, you'll be brought to the results page with a list of default trades. You can rearrange the results from highest to lowest or vice versa according to any of the column headers you see here just by clicking on them. Now, while these default results are an excellent starting point, you may want to further refine the search. So, to customize the results, you can click on Set Filters at the top of the results window, and you'll be brought to the screener page. Here, you'll find our default filters, and you can add or remove any that you like. To add a filter, just click on the Add a Filter field and then type in whatever you need. Let's say I want to search only for large mega cap stocks in my results. So I can type in market cap here, then click Add, and then I'll click on Mega. Other filters include your options trading data, like the Greeks, price changes, moneyness, and more. Plus, you also have access to filters for the underlying assets themselves, including technical and fundamental analysis information, trading prices, percent changes, dividend information, and so much more. Everything you need to fine-tune your trading experience is right here. Okay, so let's change a few of the filter values right here. Next, I'll change the days to expiration, or DTE, of the first trade leg, which is the short call, to 60 days and below. Then change the DTE for the second leg, or the long call, to between 60 and 100 days. And now I'll click on See Results. The results are sorted by highest to lowest IV skew by default. IV skew is the difference between the short and the long call's individual implied volatility. A positive IV skew is preferable because it means that the short-term option will have a higher implied volatility than your longer-dated long call, which is what traders want from the strategy. You can also have Barchart automatically screen the market for the same filters and email you the results every day. To do that, hit the Save Screener button, then give it a name, and then select when you'd like to get the emails. Okay, so let's take this trade here as an example. According to the screener, you can trade a long call calendar spread on NVIDIA with the stock currently trading at $134.43. The strike price for the long and short calls will be $135. The short call, expiring in 6 days on February 28, is priced at $5.80, while the premium paid for the long call, expiring in 83 days on May 16th, is $13.50. The net debit for the trade is $7.70. Now, let's break this trade down. Let's say, for example, that NVIDIA trades at $135 on the expiration of the short call. That means the short call has no intrinsic or extrinsic value and expires worthless. Meanwhile, the long call is now at the money and still has lots of time value left. Now you're banking on implied volatility increasing during this time, and let's assume that it is. So let's say that traders are now willing to pay $15 for your long call, and you sell it as such. To calculate your profit, subtract the initial net debit of $7.70 from the long call's current premium, and you're left with $7.30 per share, or $730 per contract in profit. Now, let's see what might happen in a loss scenario. If NVIDIA trades significantly above or below the strike price, the trade will hit its maximum loss. This is because the options premiums will become equal, and when that happens, the net premium of both options become zero. The maximum loss for the trade is limited to the net debit paid. However, the exact price where the maximum loss occurs depends on the premiums and implied volatility. But let's assume that the stock trades above the strike price, say at $150 before the expiration of the short call. This means that both options are deep in the money, and you'll want to at least close out your short call to avoid assignment. So that's screening the entire market for potential long call calendar trades. But what about if you have a specific stock or ETF in mind? Well, that's also easy, and I can show you how. First, let's go to barchart.com, then search for the asset using the search bar. And here, I'll search for Coca-Cola and click on it to get to the asset page. Once you're on the stock's asset page, navigate to the left and look for horizontal spreads. Then you can see that we're already in the long call calendar tab right here, and you'll see the trade search results. You can filter using the strike price, change the expiration date in the dropdown, rearrange the columns, or click the screen button and then the Set Filter tab to access the options screener page for a more granular search. It's really that easy. It's always a good idea to close out your short positions if they're in the money right before expiration. For the long call calendar spread, you have one active short position, the short call, so if it's in the money, I recommend closing it out to avoid assignment. This is because if the short call does get assigned, you'll be obligated to sell 100 shares of the underlying asset for every contract that you wrote. Now, if this happens, you can exercise your long call, and the shares that you buy with that trade can get sold to satisfy the assignment on your short call. The first advantage of long call calendar spreads is that they heavily benefit from theta or time decay, since you're selling a near term call against buying a long term call. It also benefits from vega or volatility expansion, increasing the value of the long call as implied volatility rises. Long call calendar spreads are also excellent in neutral to moderately bullish market conditions and can be easily adjusted by rolling the short option to extend the trade. Lastly, it has limited risk and is cheaper than long calls since the sold call offsets the cost of the long term call. On the other hand, a long-term calendar spread's profit potential is limited to the value of the long call after the short call expires. It's also highly dependent on low implied volatility, as initiating a trade with a higher IV puts you at risk of volatility contraction while your trade legs are active. If that happens, your spread will lose value. Finally, this is more complex than most option strategies. And of course, having a short call means you need to be on the watch for assignment. The long call calendar spread is best used during neutral or moderately bullish markets and benefits from theta and volatility expansion. However, it's also a complex strategy and requires precise price forecasting to get the maximum profit. That's why using any and all resources, including option screeners, will help you get the most out of your trade. If you need more information, visit the Options Learning Center, where you can learn more about the long call calendar spread and also find out other option strategies, each broken down into their working parts.